Retirement planning is one investment that you cannot afford to postpone. The earlier you start, the better your future will be. Namaste and welcome to this special conversation about investing in NPS. I am Swati Agnihotri, Marketing Head at DSP Pension Fund and your host today. Retirement planning is often discussed in numbers, savings, investment, and returns. But behind these numbers are strategies and philosophies that shape your future. Today, I am joined with Mr. Ramneek Kundra, who is the Chief Investment Officer of DSP Pension Fund. Ramneek graduated from the University of Bradford and has degree of science from NYU. Ramneek, welcome to the podcast.
Thank you. Thanks for having me.
We want to know that what made you come to the field of investment?
So I stumbled upon one of the documentaries while surfing through Netflix in 2014, I believe. And one of the documentaries was Bloomberg Game Changers, and I like to watch documentaries. And the episode was about Warren Buffett.
Okay.
So I watched that, and in that documentary, they basically Buffett basically talks about one of the books called The Intelligent Investor, and compounding sounded very fascinating to me in terms of wealth, and it always was, but I never really paid much attention to it because no one really taught, and you never really read anything about investing, and mutual fund investing was kind of picking up in India. So I didn't have that kind of exposure in finance. And once I basically heard about that book, I ordered it on Amazon almost immediately, and ended up reading it. And second time reading it in the matter of like just 2 weeks. And it's a dense book, by the way.
Yeah, I know.
And it has a lot of jargons for someone who hasn't been investing, who is not from the field of investment. So that was pretty fascinating, and that's how I began. And I bought my first stock that went up. I knew what to do. So that's why I just keep reading. And I was reading for about like 6-7 years on my own, just managing our family savings.
Okay.
And that's how the interest kept me going, and just to understand how to go forward and take the wealth forward, and how to grow it, and that's how I understood. Yeah, so do that while implementing it. So it's more of a practice combined with it's not just theoretical.
Yeah.
So you are reading and trying to implement the same in the markets.
Lovely.
Yeah.
When we speak about markets, the market has been very volatile recently, and when I mean recently, for the last couple of months. And when we invest in the market, a lot of times a question is asked that is it safe to invest in equities or to increase your stakes in equities in the given scenario? What are your thoughts about it?
So you won't know whether the market is stable. First of all, there is no stability in markets. Markets are always volatile. It's not a new thing. And people are always speculative. So there was this trader named Jesse Livermore. He used to say, speculation is as old as hills, right? So it's nothing new that happens in markets all the time. You hear these tariff news, you hear Russia-Ukraine war, you hear everything, and here we are 5 years down the line from 2020 to 2025, markets have already doubled.
Right.
And if you zoom out, in 10 years, market have quadrupled. And why has that happened? That has happened because the earnings have also grown at 13%.
Right.
In rupee terms.
Yes.
So you have to consistently think about like what are you trying to achieve over here by timing it consistently. You only got these returns when you stayed invested.
Yes, absolutely.
Whether it's DSP pension fund or any other pension fund, you have to stay invested.
Correct.
If you were moving in and out of the equity all the time, or whether bond portfolio or equity portfolio all the time, then you would not have generated even 13% return.
Absolutely.
Right? So you have to stay invested.
You mean to say that the customer should understand their risk appetite, that how much they can invest or how much risk they can take in any fund, and they should invest with the vision of a long term investment, and not go back and keep moving their funds from one direction to another direction and just stay put.
Yeah, so if you have started something in like mutual fund or pension fund, if you have started an SIP, then you should definitely stick to it.
Ramneek, walk me through your strategy of portfolio construction and how you select your stocks.
So first of all, the business should be simple to understand, and if business has a lot of subsidiaries, related party transactions, and all of that, and a lot of adjacencies, uh, you know. Uh, multiple businesses running that have no connection whatsoever to each other, it becomes a little harder to value that business and to understand that business. So first, it should be simple business to understand, or if we can separate the parts out of a conglomerate and try to understand them that way, it's much better. And second thing is, it should have some competitive advantages. It should have some mind share of the consumer, like you see in a soft drink or in tobacco or something like that. So you should have some sort of a value proposition for your customer. You should be able to make your customer's life better, whether it's through cost or just being in their life as a product. So that should be there. And third thing is, it should have clean and good corporate governance, which is, what is your capital allocation track record? How have you done with your shareholders? How have you behaved with them? How have you treated them in the past? So those things really matter to us. And when I say, like, good capital allocation, so I'm talking about return on invested capital. Over a long period of time, Nifty has grown earnings at 12 13% over a long period of time. And if something grows that long and generates something like 15% return on capital, return on invested capital, that compounds really, really well.
Right.
So the return on invested capital should be much higher than your cost of capital.
Okay.
Right? And at the same time, a good earnings growth rate is also a little bit important. And if you look at Nifty has grown earnings at something like 13% again, and that's why it has compounded at 13%. So
Right.
you need stocks which can do at least that, or somewhat better, or you need stocks which have been battered down to a point where market is expecting no returns, but
Yeah.
you expect some growth will sometime kick in, right? And all these things considered in place, there needs to be a right price that you need to pay for a business, and we do a extensive evaluation work around these businesses, and
Okay.
build the portfolio that way. And the difference between the value and the price, the higher the difference, the bigger the position for us.
Absolutely. Uh, as per the regulation, the regulator allows us to invest in BSE 200 companies, but in our portfolio, we always had less than 30 companies. Why is that?
So most of the time, the quality filters sort of that I described, simplicity, high, reasonable return on invested capital, good governance, sustainability of the business model. All these things are qualitative factors in assessing a business's strength.
Right.
If the business is good, it is very rare that you will find that at a reasonable price. Most of the time, these businesses are trading at prices you would not be comfortable owning. We would not be comfortable owning that as investors. So all these factors need to combine together. It's not one or the other, or two are okay and others are not important. Everything needs to fall in place, right? And it's very hard to get to more than 30 businesses at a time. Uh, Own those businesses beyond 30 in number or something like that. If there are more businesses trading
Yeah.
at these prices, we would definitely own them. We are not sticking to any kind of number.
Okay.
But also, there are many studies which basically show there's Evans and Archer study, there is a Statman study, which basically says, beyond 15-20 stocks, whenever you go beyond 15-20 stocks in a portfolio, the effect and the positive effect of diversification just gets to it kind of hits a plateau. And after that, you are just adding risk to the portfolio and not really reducing the risk.
Okay. Why don't we have sectors like defense or shipping in our portfolio, because they have been doing really well in last couple of months?
So, if something has done well, doesn't mean it will keep doing well, and it doesn't mean that we should be invested in it, because we buy prudence,
Right.
right? We buy rationality, and we don't buy stories. A lot of times, people would say stuff like, GST बढ़ गया है, or GST कम हो गया है, buy these stocks, or GST बढ़ गया है, buy these stocks. These are very simple stories to explain.
Yeah.
But they have no,
Precedence,
impact
yeah.
on businesses value. Not no impact, but like they have little impact on business value over a long period of time.
Yeah.
So, and these things come and go. And because as the regulations change, as the laws change, policies change, these things come and go. You have to be with sound principles, and you have to stick to a discipline and a process that you have. And usually these kind of stocks, you talked about defense, these stocks usually peak out when the order books are at their peak, not the sales.
Yeah.
So sales is part of the order book.
Correct.
As it gets executed. So it's very difficult to assess what is happening at certain valuations. And if you look at all these stocks, they are up 10x, 11x in the past 5 years. So did you have, had you told me before 5 years that, just go into defense and, these stocks would be up a lot?
Yeah.
When they went up 2x, did you
Yes.
tell me that? No, it's just very difficult to assess.
Correct.
So and something that has run up a lot, you should be rather careful, not swayed by it that it will
Right.
keep on running.
Ramneek, we keep a lot of cash in our portfolio. How does that benefit the customer?
So cash is just a residual of what is left after investing. We don't force ourselves to invest, and we don't have any number in our mind that we want to keep cash at. The maximum allowed percentage of cash according to our regulator is 10%, and we have stayed close to that number because since our inception, when we started the pension fund in December 2023, the markets have been quite elevated, and you have seen that in the last 1 year you have had flat return. For 1 year the index has not generated any kind of return, but the cash has earned 6-7% in liquid funds.
Right.
So cash has actually outperformed in the last 1 year.
Yes, absolutely. I remember that.
So usually when the markets are high, you would see our cash levels a little bit elevated, and when markets are low, we end up deploying that. And we did that last year in June 2024 when the markets went down during the election phase, and we ended up deploying some of those, some of the cash that we had in the positions that we held.
DSP Pension has given exceptionally high returns in the recent past. How do you plan to maintain them for the future? This is a very commonly asked question from a lot of people.
So yeah, we cannot plan returns, first of all.
Yeah.
I don't think we can plan or anyone else could, but I would like to learn if someone can. So we don't plan anything in terms of returns. What we have a plan to do is stick to our discipline, stick to our framework. So our investors should judge us based on how strictly we adhere to our investment framework, and whatever we say, are we doing the same? And over time, underperformance of any fund is just an inevitable outcome
Okay.
over time, over one time frame or the other. 1 year you will outperform, 1 year you can underperform. Over a 3 year period you can outperform or underperform. But what will happen with sound investing process is, what we have seen is, over a 5 year, 6 year, 7 year period, the prudence just shines out. And as Ben Graham in The Intelligent Investor basically said, market is a voting machine in the short run, but it's a weighing machine in the long run. So
Wonderful.
everything that is there regarding the business comes out to the fore over a long period of time. In the short term, you'll see a lot of fluctuations, but over time, everything becomes a bit clearer.
We have seen underperformance in the recent past, from very high performance to underperformance for our last couple of months. What do you want to say to our investors who are looking at the underperformance right now?
So yeah, I mean, 6 months underperformance or 1 year underperformance, it's really a byproduct of being invested in a fund, right?
Okay.
And it's very normal. So even I would be concerned if I'm investing, if I'm underperforming for 5-7 years. But the thing
Absolutely.
is, over time, I think our sound process, and you should think in terms of probabilities, right? Like our sound process has a probability of outperforming by a little bit, over a long period of time. And I'm not over a long period of time. What I mean is over a period of 7, 8, 10 years, right? And the investors who are looking at few months underperformance, again, I would remind you that this is a pension fund,
Yes.
right? On one hand, you are thinking of retiring at 60.
Yeah.
On the other hand, you are looking at 3 months, 6 months underperformance. That's not good for your well-being in terms of financial well-being. So you should look at things on a longer term, take a longer term horizon and look at things that way.
So I would go back and circle to the previous point that we have raised, is that if you have selected a fund on the upside,
Yeah.
do not worry when it is on the downside,
Yeah.
because you have selected it because of certain policies, certain strategies, certain philosophies, certain way of work for a longer period of time. And you have also weighed in the risk. You have given you have thought about your risk appetite and then selected the fund. So if you have selected anybody in last 6 months and you have seen underperformance for them, then that is not the time to worry about it, but just relax and see that where the money is actually invested. This is the time to go back and be very confident about the portfolio that you have selected.
Right. That's true.
Thank you so much. Now I want to get a little bit more specific. Now there are 10 fund managers in NPS, and everybody is investing as per the common investing guideline, right? It's a common playground for everybody. Then why should one select DSP Pension?
So my personal money is invested with DSP Pension Fund.
Nice.
Like my pension, all my pension goes to DSP Pension Fund. So first of all, I have skin in the game in that sense. And our motto as DSP Group is do good, be good.
Yes.
And it's a high integrity company. And what we do is, we are one of the most transparent pension funds out there. There is no one that I know who discloses their framework, has a well thought out written framework on their website or anywhere else, or blogs. And we are the only ones writing half yearly letters and annual letters. And I mean, half yearly we wrote only for 1 year because it was a new fund. And now we have annual letter coming out probably in December.
Correct.
And then we also communicate through our personal social media handles, whether it's Rahul or it's me. We consistently write, and there are no pension funds that I see who do that. So you should just look at whether the fund manager is, adhering to to what he or she has told you. And I think we do that. Okay.
So
Yeah, even in our first letter, we wrote like, it doesn't matter to us whether we are one of 11 pension funds or 11 out of 11 pension funds. It
Yeah.
doesn't really matter in the short run.
Yes.
But we would be concerned if 5 years from now, we are just underperforming the benchmark, which is BSE 200. We would be, that would cause me sleepless nights because that's what I'm paid for.
Right.
To outperform the benchmark. And we try to do that reasonably with prudence, and rest is in market's hands.
Coming to an end, what do you want to tell to our investors who have selected DSP for a long term?
I mean, just stick with it. If you think our thought process and our investment framework is prudent, just stick with us. Don't chase our performance. If you come to us for performance, you're going to leave us for underperformance, and that's not, again, good for your financial well-being. It hurts both the sides. We lose you and you lose us and you lose the returns.
Yeah.
So it's just in both the parties' interest to that you stick to your asset allocation and continue your SIP in a disciplined way.
So stay invested, stay disciplined, and choose the fund manager that you can stay with for a longer duration.
Yes, definitely.
Do not hop around. Do not look at, or don't get unconfident or about your own choices.
Right, that's right.
Thank you so much, Ramneek.
Thank you. Thanks for having me.
I'm Swati Agnihotri in conversation with Ramneek Kundra on DSP Pension Fund podcast. Thank you for tuning in, and until next time, plan early, stay steady, and trust the process.